Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video I'm going to be solving the MA Specimen exam which is available on the ACCA website. This is a very useful resource, not only because it will give you an exam style practice, but also since it is hosted on the same software that is used for your real exam also, this will also give you the practice to navigate in this software. So let's get started. The first question is, a manufacturing company benchmarks the performance of its accounts receivable department with that of a leading credit card company. So we have to tell over here that which kind of benchmarking is the company using. So it is clearly mentioned over here that for their receivables, they are using similar policies like credit card company. So this is a function. That is why this will be a functional benchmarking. So, they are using functional benchmarking because this is an internal function which is similar to another company, even though these industries are working in different sectors. So, this is a manufacturing company and credit card company has a different sector, right? But still, this is one function which is common, which is similar to both companies. So, that is why functional benchmarking would be your answer. Moving on, which of the following best describes target costing? So, let us first revisit what we do in our target costing. So basically, we first of all set the selling price, and then we add some sort of profit that we want to have over here, and then we arrive at the manufacturing target cost, right? So this is how we arrive at target cost in our target costing approach. So let's see which option talks about that. So setting a cost by subtracting a desired profit margin from a competitive market price. So this is exactly what we do, right? We set a selling price, competitive market price, and then we subtract a desired profit margin, and then we set a cost. So yes, first option is the right answer. Now let's eliminate the other ones also. Setting a price by adding a desired profit margin to a production cost. Now this is wrong because you arrive at a cost, you get a target cost, right? So this is why second is wrong. Setting a cost for the use in the calculation of variances, no. Setting a selling price for the company to aim for in the long run, no. Target costing arrives at a target cost and not a selling price. So with this, let's move on to the next one. So we have information relating to two processes, F and G, and these are the normal losses as a percentage of input. And then we have the input given also, and then the output. Now for each process, was there an abnormal loss or an abnormal gain? So let's work that out. For both of these, we have to give our answer over here. So I can see that for F, 65,000 is my input and 8% is a normal loss. So how much my output should be is nothing but 100 minus 8%, 100% minus 8%. So if I just find out 92% of 65,000, I'm just doing this on my calculator. So 65,000 multiplied by 92%. So this gives me 59,800. So I should have obtained this much output, and the output that I have actually obtained over here is 58,900. So clearly my output is lesser than what it should have been. So that is why I can say that there's an abnormal loss in my process F. Now let's perform similar workings for process G also. So this is 37,500 was my input, and then 5% is my normal loss. So 100% minus 5% should be my output. So if I just calculate 37,500 multiplied by 95%, I will get my answer as 35625. So this should have been my output, and my actual output is 35,700. That means my actual output is more than how much it should have been. So that is why I can know that process G has an abnormal gain. Now we are done with this one. Let's move on to the next one. So we have information given for a manufacturing company. We have production, we have sales, we have fixed production costs, fixed selling costs. Okay. The normal activity is also given. Using absorption costing, we see that the profit is $36,000 and we have to find out the profit using marginal costing for the next period, right? So what we'll do over here is, first of all, we see that the production is 14,000 and the sales is only 12,000. That means we have a closing inventory of 14,000 minus 12,000, which is 2,000. So I can say that my closing inventory is 2,000 units. Now, when inventory is increasing, we have a closing inventory over here. So the profit under your absorption costing will definitely be higher than your profit under marginal costing. So let's find out how much is the difference in the profit, right? We have to find out how much the profit will be. So we have 36,000 given, and if we take out the difference, then we'll be able to answer the question using the marginal costing method. So we have 2,000 units as our closing inventory, and the fixed production cost that we have over here is 63,000. And this 63,000 is going to be spread over the produced units, which is nothing but 14,000. So with this, I can see that my absorption rate will come out to be 63 by 14 is 4.5. So this is my absorption rate. Now I have 2,000 units of closing inventory with me. So my difference in profit will be nothing but 4.5 multiplied by 2,000. So 4.5 multiplied by 2,000 will give me 9,000. Now my answer will be lesser over here in the marginal costing. So my answer is 36,000 minus 9,000, and this will give me my answer as 27,000, and this is what I will be entering in the blank over here. So this is 27,000. We will not be putting any circle, any commas over here, because you are not supposed to be entering commas in your answers. Now let's move on to the next one. The Eastland Postal Service is government owned. The government requires it to provide a parcel delivery service to every home and business in Eastland at a low price, which is set by the government. Express Couriers Company is a privately owned parcel delivery company that also operates in Eastland. It is not subject to government regulation, and most of its deliveries are to large businesses located in Eastland's capital city. You have been asked to assess the relative efficiency of the management of the two organizations. Now, we have to the requirement says which of the following factors should not be allowed when comparing the ROCE of the two divisions to assess the efficiency of their management. So, objectives, prices, workforce motivation, and geographic areas. So basically, we should not be allowing for the workforce motivation. Why? Because the motivation of the workforce cannot be measured in an objective way. So, workforce motivation is something that cannot really be quantified. So how can you be, allowing for this? So that is why workforce motivation should not be considered over here. Rest everything you can see can be measured. Objectives can be measured. How much you have achieved your objectives can be found out using different measures. Then prices also are quantitative. Then differences in geographic areas served. So how many customers you are catering to, this can also be quantified, but workforce motivation cannot be quantified. Moving on to the next one. Under which sampling method does every member of the target population have an equal chance of being in the sample? So definitely we have learned in our study text also that random sampling is the sampling where you are, going completely random. Every member of the population has an equal chance of being selected. Moving on to the next one. A company manufactures and sells one product which requires 8 kg of raw material in the manufacturing. We have the data given, sales is given, opening inventory is given, closing inventory is given. We have the opening inventory of raw materials and the closing inventory of raw materials as well. We have to find out over here what are the purchases for the next period, purchases of raw material. So first of all, we have to find out that how much will we be producing in this time period. So for the production, we can say that how much we are going to sell. So sales plus your closing inventory, because that is also something that we are going to be making over here. So I can say that this is my closing inventory, and then I subtract anything that I had previously made. So that is my opening inventory. So I can say that my production this time is going to be 19,000, plus my closing is 3,000, and then my opening is 4,000. So that means I'm going to be producing 18,000 units in this time period. Now how much inventory do I need to produce these 18,000 units? First of all, we also have to multiply this 8, because 18,000 units and each unit is taking 8 kgs of raw material. So to convert it into kg, I will say that 18,000 multiplied by 8 is going to be my requirement. So if I just carry out this on my calculator, this is 144,000, and this is in kgs, right? So we do have an opening, again the purchase budget will remain the same, the formula. First of all, we'll take the usage, which is 144,000. Then we add our closing inventory, because this is something that we need to keep for the next period. And then we also have the opening inventory, which we will not be purchasing this time. So what our final answer will look like is 144,000 plus your closing inventory which you want to keep, and then minus any opening inventory that you already had. So this will give you your final answer as 147,000 kg. Now kg is already written over here, so I'm just going to say that my answer is 147,000. Right, so we move on to the next question now. So it is given that up to a given level of activity in each period, the purchase price per unit of raw material is constant. After that point, a lower price per unit applies both to further units purchased and also retrospectively to all units already purchased. So we have to find which of the following graphs depicts the total cost of the raw materials for a period. So let's have a look at our options. Now, first of all, we need to see over here that raw material costs are changing with activity, right? So our graph will always have to begin from the origin. Now, all four of the graphs are beginning from the origin, so we cannot, right? So graph 3 does not begin from the origin, so we can eliminate graph 3 completely. Now, when there's a fall in price per unit, the line has to have a vertical drop in the middle, right? So there has to be a vertical drop in the middle. Now that is only option 1 and option 4. Now let's have a look at the other things that are supposed to happen. So the correct answer that I can see over here has to be graph 4, because the line after the fall in the price would also go through the origin if it is, scaled to that level. So this shows that your cost is variable and this will increase in proportion to your activity. So that is why graph 4 is your answer over here. Now let's have a look at our Sorry. So graph 1 is going to be our answer, because this says that, your extrapolated line should pass through the origin. So if you just try to, extrapolate this, so this will roughly pass through the origin, and this means that your costs are completely variable. So option 1 is your answer over here. Let's move on to the next one. Right. So, which two of the following are benefits of budgeting? So, it helps coordinate activities of different departments. Yes, this is definitely true. Budgets are legal reporting obligations. No, this is wrong. Budgets are prepared internally for the management, for their objectives, and rather than having it a legal obligation. Then it establishes a system of control. Definitely, yes. When you have created budgets, you can catch hold of your employees. You can control that. Okay, why, when we had told you that this much should be the cost that you spend on this, why have you gone overboard with that? So it is a starting point for strategic planning. Not really. They can be translated into your tactical and operational goals, but it cannot be used for your strategic planning. Now let's have a look at the next one. The following statements relate to participation of junior management in setting budgets. It speeds up the setting of budgets. Definitely not when there are a lot of people involved. It takes time to do things, right? So, you will first ask for their participation and then you will decide what is wrong, what is right, and then you will set the budget. That is why it will not speed up the process. So, option 1 and 4 can straight away be eliminated. It increases the motivation of junior managers. Definitely, yes. When you are involving them more in companies' decisions, they will feel more motivated. And then it reduces the level of budget padding. No, this is not what participation of junior management does. So, option 2 only is your right answer. Now, let's have a look at the next one. There's a capital employed of $200,000. The cost of capital is also given to us, and then the residual income is given. Now, we have to find out the company's return on investment. So, return on investment, first of all, if we write the formula, is nothing but your operating profit divided by your capital employed. And since it is a percentage, you multiply that by 100. So, first of all, we have to find out our operating profit over here. So, how do we get to that? We are told that we have a residual income of $36,000. Now, we know that residual income is nothing but your operating profit minus your uh, interest, right? Cost of capital, you can say. Cost of capital would be a better word over here. Cost of capital. So RI is given to me as 36,000. And if I have to find out my operating profit, I can just add my cost of capital over here, which is nothing but 12% of 12% is the cost of capital given to us, and of the capital employed. Capital employed is 200,000. So I can say that this will give me my operating profit. And if I just add both of these figures up, I will get my operating profit as 36,000 plus 24,000, and that will give me $60,000. Now I have everything that I need for my final answer. I have to put the values in the formula that I've just put over here. So operating profit I found out as $60,000, and I will divide this with the capital employed, which is $200,000, and then multiply this by 100. So my answer will come out to be 30%. Right? So this is my answer. Now moving on to the next question. Right. A company has calculated a 10,000 adverse direct material variance by subtracting its flexed budget direct material cost from its actual direct material cost for the period. Now we have to pick two statements over here which could have caused the variance. Now we also have to consider that they have flexed their budget. So anything that we have to consider that we have already flexed our budget, so it cannot be due to units produced being greater than budgeted or less than budgeted. So that cannot be our answer. So we can eliminate option 3 over here, units being produced greater than budgeted. Since we have already flexed the budget, we do not have to consider for unit differences, right? Units being sold greater than budgeted again can be eliminated. So anyway, we are left with only first two options. So these have got to be the answer. Now let's see why these are the right answers. So an increase in the direct material price, this definitely can cause your material variance to be adverse, because here you are comparing how much your price you have budgeted and how much it actually cost you. So if the cost has gone up, definitely this will lead to an adverse material variance. Now, increase in raw material usage per unit, definitely yes. If you have actually ended up using more material, then definitely your material variance will be adverse. Then let's have a look at the next one. A company has recorded the following variances for a period. So we have a sales volume variance, sales price variance, and the total cost variance. We also are given that the standard profit on actual sales for the period was supposed to be $120,000. Now, what is the fixed budget profit for the period? We have to find out that how much is the fixed budget profit. So let's have a look. First of all, we know that the difference between your fixed budget profit and your standard profit on your actual sales gives you your sales volume variance. So I can write the formula over here as well. So your fixed budget profit will be nothing but the sum of your standard profit on actual sales plus your sales volume variance. So I just have to add these both figures that are given to me over here. I can see that my standard profit is given to be 120,000, and I have to add my sales volume variance, which is 10,000 adverse. So my answer will be 120,000 plus 10,000, and this will give me my answer as 130,000. So I will mark this and I will move on to the next question. Which of the following are suitable measures of performance at strategic level? So return on investment, definitely yes. This is something that the strategic level managers look at. Market share, definitely yes. Number of customer complaints is a rather lower level management sort of a thing. It's at the operational level and not at the strategic level. So that is why option 1 and 2 is your answer. Moving on, which two of the following are feasible values for the correlation coefficient? So we always know that your correlation coefficient has to lie between -1 and +1. So 0 is the value that lies between -1 and +1, and then minus 0.94 also lies between -1 and +1. Again, if we look at the first two options, plus 1.4 is more than +1, and plus 1.04 is again more than +1, and it cannot go beyond +1. So that is why these two are our answers. Moving on to the next one. A company's operating costs are 60% variable and 40% fixed. Which of the following variances values will change if the company switched from standard marginal costing to standard absorption costing? So we know that over here the sales volume variance will change, because under the marginal costing, this is valued at standard contribution, and under the absorption costing, it is valued at your standard profit. So that is why if there are, the operating costs are 60 variable and 40 fixed. So this is what will be changed. The sales volume variance will change if you switch from a marginal costing approach to a standard absorption costing approach. So now let's move on to the next one. ABC company has a manufacturing capacity of 10,000 units. The flex production cost budget of the company is as follows. So at the capacity of 60%, the production costs are 11,280, and then you're at 100%, it is 11,1520. So how will we find out the difference over here? We are also given that the maximum capacity is 10,000 units. That means at 100%, my how much I'm producing is 10,000 units, and at 60%, I'm producing 6,000 units. So let's work out our calculations. So this is 6,000 units and this is 10,000 units. Now we have to use the high-low method over here. So basically what we'll do is variable cost will be equal to 15,120 minus 11,280, and this will be divided by the difference between your units produced, which is 10,000 minus 6,000. So if you solve this, you will get your variable cost per unit as $0.96. Now you can use any of the two activity levels to find out the fixed costs. I'm using the 15120 level. So I know that my my total cost is nothing but variable cost plus my fixed cost. So if I have to find out my fixed cost, it will be nothing but total cost. Total cost is 15120 minus my variable cost. So I am producing 10,000 units. 10,000 multiplied by 0.96. So I will find out that my fixed costs are 5520. So sorry, I put it as 280. It is 20. This is 5520. Right. So now we have to find out the total production cost if we are operating at an 85% capacity. So at that capacity, the fixed cost will remain same. It is only our variable cost which is going to be changing. So let's work out the total cost. So the total cost will be nothing but 5520 plus your variable costs. We are producing at 85% capacity. It is 85% of 10,000 units, which will give you 8,500 units, and per unit cost is 0.96. So if you solve this, you will have your answer as 13680, and same I will put in over here. It is 13680. Right. With this, I move on to the next one. Using an interest rate of 10% per year, the net present value of a project has been correctly calculated as $50. Now, if the interest rate is increased by 1%, the NPV of the project falls by $20. Now, we have to find out that what is the IRR of the project. So basically, IRR is nothing but the cost of capital at which your NPV is 0. So we are told over here that at 10%, your NPV is $50. And at 11%, your NPV falls by $20. So 50 minus $20 is nothing but $30. So similarly, if I go to 12%, so the NPV will again be 30 minus 20. This will give me $10. So therefore, at $13, it will be again 10 minus 20, which will give you minus 10. So somewhere in the middle, your NPV will come to 0, and the middle of 12 and 13 is nothing but 12.5%. So this is the right answer. Moving on to the next one. A factory consists of two production cost centers, P and Q, and two service cost centers, X and Y. The total allocated and apportioned overhead for each of these is given to us. It has been estimated that each service cost center does work for other cost centers in the following proportions. The reapportionment of service cost centers to other cost centers fully reflects the above proportions. So we have to tell that after the reapportionment of service cost center costs has been carried out, what is the total overhead for production cost center P? So we have to work out that how much it will be after the reallocation. So first of all, we can see that to P already 95,000 is allocated and apportioned. So 95,000 will be taken as it is. Then we have a look at this. So for percentage of service cost to P, they are doing 30% over here. So we will be taking 30% of our 30,000 because that is the amount it is allocating to Y. So I will add over here 30% of 30,000. So 30% of 30,000 comes out to be 9,000. So I will be adding $9,000 to my already allocated costs. Now, another thing, what other service is being provided to P? It is provided by X and 50% of that. So X has a total of 46,000, and then we will be taking 50% of that. So 50% of 46,000 This will give you your answer as. Okay, so first of all, we also have to consider over here that there will be some costs that are also allocated to X. So we can see that 10% of Y's costs are also attributable to X. So 10% of 30,000 is 3,000. That means a total of 49,000 is attributable to your X, right? So now we will be taking 50% of this to our division P. So I will be taking 50% of 49,000 and that will be 24,500. So now if I just add all of these figures up, I will get 128,500 and this is my final answer. I will pick up this option and this is 128,500. Now moving on to the next one. Right. So, J company uses a job costing and uses standard net profit markup of 20% on total cost to calculate the selling price. Now, the selling price is given as 672 and fixed overheads are 340. So, we have to find that how much is the variable cost for this job. So, we see over here that our selling price is 672, right? And then we have a markup and we have a markup of 20%. So we are already given over here that, 672 is our selling price, and this includes a markup of 20%. So I can say that my cost is nothing but 672 divided by 1.2. And if I find this, this will come out to be 560. Now, another way to understand why we did that is, so we know that selling price is nothing but the sum of your cost plus your profit. And my profit is nothing but 20% of the cost. So my selling price is cost plus 0.2 cost. So I can say that my selling price is 1.2 cost. And if I have to find out my cost, I will take the selling price and divide this by 1.2 to find out how much my cost will be. So now I know that my total cost is $560. Now I am also given over here that 340 is my fixed proportion and I have to find out the variable from this. So it is nothing but the difference between these two. So 560 minus 340 and this will give you 220 as your answer. You will mark this and let's move on to the next one. So which two of the following statements about the principal budget factor are true? So it restricts the performance of an organization for a given period. Now this is true. When you are having a principal budget factor, this will restrict the company from making maximum profits. Also, you will see that there will be the factor that it restricts will be sales, but there can be other limiting factors also. So now let's have a look at the next one. It dictates the minimum levels of budgeted production possible. No. It is the lowest level of sales that an organization can achieve in the budget period. No. It affects the order in which an organization prepare its budgets. Now this is also true because when you are preparing the budgets, the principal budget factor is nothing but the starting point, and all the budgets will start and then continue from this level. So now let's move on to the next one. A company uses marginal costing. The following variances occurred in the last period when the actual net profit was $40,000. So we have materials, labor, overheads, sales price, volume contribution, and then we have to find out what is the budgeted net profit for the last period. So what we will be doing over here is that we will be considering what all we have to take to find out the net profit, right? So we see over here that the actual net profit was $40,000. So everything will be worked out from this starting point. So 40,000 was something that I was supposed to be earning. Then I spent 900 extra on my materials. So I will be adding that because I have to arrive at what I had actually budgeted. So I had budgeted that my materials will cost 900 lesser. So my profit has been reduced by 900. So if I have to find out my increased profit, I will be adding everything adverse and I will be subtracting everything which is favorable, because earlier I had anticipated that this will be expensive, but labor came out to be $1,000 cheaper. So I will be subtracting 1,000 from here. Then 700 is adverse, so I will add that. Then there is 500 favorable, so you subtract that. And then again, there's 900 favorable, so you subtract that. So your final answer will come out to be 39,200, and this is option 1. Now let's move on to the next one. Identify whether each of the following statements about the uses of big data analytics in organizations is true or false. So it helps to create to better understand customer behavior and preferences. Now this is very true, because when you are using big data, you will definitely be able to gain better insights into what customers like more, what are they choosing more. So definitely this will help you to understand better the behavior and their preferences. It helps to analyze the efficiency of business processes in real time. Now this is also true, because big data analytics will help you to also find out that which process you are doing well and which process you are not doing well. Now, Camel Company plans to make an immediate investment in a new product of $100,000. The project's the product's net cash flows are expected to be as follows. So we are given with the cash flows. Camel Company uses a discount, cost of capital of 10%. So we are also given the discount factors over here. We have to find out the discounted payback period. Okay. So first of all, we will have to create a table over here, and we'll have to see that how much our payback period actually is. So I see that in year 0, I have to make an outflow of $100,000. So 0 is minus 100,000. And then I also, so the discount factor for year 0 is nothing but 1. So I can say that my discounted cash flow is $100,000. So then I move on to year 1. So here let's do the cumulative also. So for year 1, I have my inflows as 35,000 and the discount factor is given as 0.909. So if I discount this, I will have my discounted inflow as 31,815. So earlier I was having a negative 100,000. Now if I add 31,815 to negative 100,000, I will be left with negative 68,185. Now similarly, I do this for the year 2. So for year 2, this is 45,000 and then the discount rate is 0.826. So this will give me 37,170, and if I add this to the 68,185 figure, this will give me a negative 31,015. Now moving on to year 3. Year 3 has 60,000 in positive. So 60,000 and the discount factor is 0.751. So I will multiply this and I will have my answer as 45,060. Then if I add this up, I will be having a positive figure over here, which is 14045. So now I can see that I have obtained a positive figure. The payback will definitely occur between 2 to 3, year 2 and year 3. So I will find out how much proportion I am needing of the year 3, because year 2 is complete. In year 2 we were still negative, but somewhere in the middle of year 2 and 3 we have achieved our payback. So what we'll do over here, we were needing 31,015 more, right? So this was the money that we needed more in this year, in the third year. And how much is the total that we are earning in this year? It is 45,060. So I can say that I needed 0.68 of this year more. So I can say that my payback is nothing but 2.68. Now let's have a look at what the rounding of instructions of the question are. We have to discount it to nearest 0.1 years, which means 1 decimal place. So 2.68 will become nothing but 2.68. 7. So this is what we will be entering over here, and then we move on to the next question. So let's read. A company manufactures and sells a single product in 2 consecutive months. The following levels of production and sales in units occurred. So in the month 1, there were sales of 3,800, 4,400. Production is also given. Okay. So let's have a look at what the requirement is. Which of the following combinations of profits or losses for the 2 months is consistent with the above data? So we have to work out our profit and loss for the 2 months using these two methods, absorption costing as well as our marginal costing. So let's have a look at the given information again. So let's work out how much our profits and losses will be. So first of all, in month 1, we see that we have an opening inventory of 400 units. So I can say that this is month 1, this is month 2. So my opening inventory is 400 units, and plus how much have I produced? I have produced 3,900. And then I have, if I add this up, this was my production. So my total becomes 4,300. Now out of this 4,300, I have sold 3,800. So I subtract my sales. So my sales are nothing but 3,800 minus sales. So 3,800, and I'm left with 500 units, which becomes my closing inventory, right? Similarly, I will carry out this, calculation for month 2. This month's closing is the next month's opening, so 500, and then my production is 4,200. So adding 4,200 to this, I will have my total as 4,700, and then I can subtract my sales. My sales are given to me as 4,400, so minus 4,400, and this will give me my closing inventory as 300. So, what we are supposed to do over here is that in the month 1, our closing inventory is higher than our opening inventory. So, we have a closing of 500, whereas our opening is 400, right? So, in the month 1, we do have a higher closing inventory. So, basically, what will happen over here is our absorption costing profit will be higher than our marginal costing profit. And then in the month 2, your closing inventory is lesser than your opening inventory. So that is why the marginal costing profit will be higher than your absorption costing profit. So let's have a look that which option is reflecting these scenarios. So in option 1, what we discussed over here was that our absorption costing profit will be higher than marginal in the month 1. So absorption costing will be higher in month 1. So this is lesser, so eliminated. Again, this is lesser, so eliminated. 200 is higher than minus 400. So option 3 could be our answer. And this is again, the last option is again eliminated because for the month 2, we are supposed to choose an option where your marginal costing profit will be higher than your absorption costing. So marginal has to be higher. Marginal is higher, 4,400, than your absorption costing. So this is your correct answer. Moving on to the next one. The following statements relate to the advantages that linear regression analysis has over the high-low method in the analysis of cost behavior. The reliability of the analysis can be statistically tested. So yes, definitely this is true because your regression analysis is is calculated using statistical methods. Then it takes into account all of the data. This is also true. And then it assumes linear cost behavior. No, this is not the assumptions of your regression analysis. That is why only statement 1 and 2 are correct. Moving on to the next one. Which two of the following are examples of direct data capture costs? So we have input of data into the production system by operational staff. No. Then payroll department processing employee costs. No. Completion of timesheets, yes, because this is something that you are directly incurring to capture your data. Purchase of barcode scanning and equipment, definitely this is also again some direct cost that you are incurring to capture the data. Moving on, which of the following would not be expected to appear in an organization's mission statements? So major stakeholders will definitely be there. Quantified short term targets the organization seeks to achieve, no. Mission statement will always talk about something long term, so this is something that will not be appearing. Products or services will definitely appear. The values and beliefs will also appear. Moving on, an organization operates a piecework system of remuneration, but also guarantees its employees 80% of a time based rate of pay, which is based on $20 per hour for an 8-hour working day. 3 minutes is the standard time allowed per unit of output. Piecework is paid at the rate of $18 per standard hour. So, what we have to work out over here is that if an employee produces 200 units in 8 hours on a particular day, what is the employee's gross pay for that day? So we have to see that he's producing 200 units on using the 8 hours, right? So how much is basically the time that he should be using for 200 units? So for 200 units, it is said that 3 minutes is the time allowed, right? So 200 multiplied by 3 minutes, so this will give you 600 minutes. If you divide that by 60, you will get your answer in hours, and this will give you 10 hours. So basically, he was supposed to be using 10 hours, but he used only 8 hours. So that means his gross pay will be nothing but 10 hours, because 10 hours is the is the worth that he has done work, and then this will be multiplied by the standard rate, which is 18. So this will give you your answer as 180, and we will be entering this over here. Right. So moving on to the next one. A company uses an overhead absorption rate of 3.5 per machine hour based on 32,000 machine hours budgeted for the period. During the same period, actual expenditure amounted to this much, and 30,000 machine hours were recorded on actual production. So what we have to see over here is that we have to find out how much by how much was the total overhead under or over absorbed for the period. So let's first find out how much we have actually absorbed. So how much we have actually absorbed? We have worked in actual 30,000 hours, and then we are absorbing at the rate of 3.5. So this will give you your actually absorbed overheads as 105,000, and how much you have actually incurred is nothing but 108,875. That means you have absorbed lesser, and by how much? 3875. This is what you have actually incurred, and this is what you have absorbed. So you have absorbed less. So it is under absorbed by $3875. Moving on to the next one. Which two of the following statements relating to management accounting information are true? So no strict rules govern the way in which it is presented. Definitely yes, since it is not legally required, so there's no specific format for this. The management can decide how they want it to be presented. It is produced for parties external, no. It is used for the management, which is internal party. It may be presented in monetary or non-monetary terms. Definitely yes. The management can be looking at both information, which is financial as well as non-financial. There's usually a legal requirement, no. So again with elimination also, you will reach at the right answer. Moving on, a company's sales in the last year, in its 3 years in in three different markets, were as follows. So it's for 1 year, and in which they have sold in three different markets. A pie chart representing the proportion of the sales made in each market. What would be the angle of the section representing market 3? So what basically we have to do, this is a very simple question. We'll take the sales of market 3, which is 51,000, and then we divide this by the total market, which is nothing but 300,000 total sales, and then we multiply that by 360 degrees. So if you carry out this calculation, you will get your answer as 61 degrees. Main sources of data can be classified as social, human, or machine, which is sensor, and transactional. Which of the following would be classified as a transactional data? So a GPS tracking system is again a machine. Output of a fitness tracker is again a machine or a sensor. Content of a blog post is again social or human. Purchase order is something which is transactional. The purchase price of an inventory item is 25. Okay, so we have to work out the EOQ over here. So the EOQ formula I'm writing, it is nothing but under root of 2 into annual demand multiplied by how much is the cost of ordering, and then you divide that by the annual cost of holding. So let's put in the values from the question. So I am going to have to take an under root of 2 multiplied by how much is my annual demand. So my annual demand is 20,000. So 20,000 is given for a 3-month period. So for a year, if I have to convert this, so I will multiply this by 4, and this will give me 80,000 units as my annual demand. Now I will multiply this with the cost of ordering. So the cost of placing the order is also given to us as $20. And then let's find out how much our holding cost is. So the holding cost associated with 1 unit equate to 6% of its purchase price. So I will take the purchase price is given as 25. So 25 multiplied by 6%. So if you find out, if you work out this calculation, you will get your answer as 1461. So this is what you will answer and move on to the next one. The results of a chemistry examination are normally distributed with a mean score of 56 and a standard deviation of 12. Now, what is the percentage probability that the student will score more than 80? So, we have to first use the Z score over here. So, the Z score is nothing but how much you have to work out. So, 80 minus how much is your mean, which is 56, and you divide that by your standard deviation. So, this is 2. Now you go to your normal distribution table. Do we have this given over here? Let's see. Right. So this is given to us, normal distribution table, right? So we have to look at 2. So for 2, I can see that this is going to be right. So this is 0.4772. So I can just write this over here. I hope that the table was visible to you. It appeared as another pop-up. So the Z's from the normal distribution, I can see that for 2 it is 0.4772. So to find out the probability, I will simply subtract this from 0.5. So 0.5 minus 0.4772 will give you 2.28%. So percentage sign is already given, so I will just put 2.28 over here. Now moving on to the next one. Okay, so with this, we have come to an end to our section A of the exam. Now let's move on to section B. So this is the first question in our section B. Cab company owns and runs 350 taxis and had sales of $10 million in the last year. It is considering introducing a new computerized taxi tracking system. The expected costs and benefits are given to us. Okay, so let's have a look at the requirement first of all. In order to determine whether the computerized tracking system should be introduced, indicate whether each of the following is a relevant or an irrelevant cost for a NPV evaluation. So when we are looking at a computerized tracking system investment, okay, so it is mentioned that the system would cost this much to implement. So yes, this is definitely relevant because it is specific to whether we will take this up or not. So this is relevant. Moving on to the next one, depreciation of 420,000 in each of the 5 years. Again, this is irrelevant because depreciation is a notional cost. Moving on, Staff training costs of 425,000 definitely relevant because it will only be incurred because of undertaking this computerized tracking system. So yes, this is relevant. New staff total salary, again relevant because this is a future cost and it is an incremental cost. They are recruited specifically for the project, right? Now let's move on to the next one. Staff training costs of $75,000. So let's read about that. Would also have to no, what about the 75,000? Right. $75,000 has already been spent on staff training in order to evaluate the potential of the new system. So now will this be relevant? No, because this is a sunk cost. We have already incurred this. So interest cost of 150,000 per annum. Again, this is irrelevant. Why? Because this is a notional cost. The NPV will be discounted as at the cost of capital, and that will give you the NPV, right? So the interest as a whole of 150,000 is irrelevant for the NPV calculation because that will be taken care of with the discount rate. Now let's have a look at task 2. Task 2 says that calculate the following values if the system is implemented. So first of all, we have to see that how much our incremental sales in year 1 will be. So let's have a look at what is said in the question. The sales are expected to rise to $11 million in year 1 if the new system is implemented, thereafter increasing by 5% per annum. If the system is not implemented, sales will be expected to increase by $200,000 per annum. So we have to say how much is going to be our incremental sales. So increment, we are told that with the investment it will be 11 million, and without the investment there will be a increment of 200,000. So currently I can see that my sales are 10 million and 200,000 will be added if we are not implementing. So 10.2 will become the uh, sales if we are not implementing this system. So incremental will be nothing but the difference between the two, 10 million and 10.2 million, which will give you your answer as $800,000. So I will just enter this over here, 800,000. There have to be no spaces in between this. Now moving on to the next one, we have to tell the savings in vehicle running costs in year 1. So let's have a look at what the scenario says about that. Right. Despite increased sales, savings in vehicle running costs are expected as a result of the new system. This is estimated at 1% of the total sales. So if the system is implemented, you are going to be earning a sales of 11 million. So 1% of 11 million will give you $110,000. So that is what you will be entering over here, $110,000. Now let's move on to the next one. Present value of the maintenance costs over the life of the contract to the nearest $1,000. So let's have a look over here. What about the maintenance costs? Right. So cab company would have to take out a maintenance contract of the new system at a cost of $75,000 per annum for 5 years. So basically, what you will do over here is that you will take 75,000 and you will multiply that by how much is your annuity factor. So again, if I go to my table and my annuity table, so this is for 10% is the cost of capital and this is for 5 years. So 10% for 5 years is 3.791. So I will multiply 75,000 with 3.791. So 75,000 multiplied by 3.791. And with this, you will get your answer as 284,325. So it is mentioned with respect to the rounding of instructions, we are told okay, why did this answer disappear? It was 110,000. Right. Moving on to this one now, we have to take it to the nearest thousand. So basically, this is 325. So I will round it down. It is lesser than 500. So I will make it as 284. 000. So 284,000. This is going to be my answer. 284,000. Right. Now I move on to task 3. Cab company wishes to maximize the wealth of its shareholders. It has correctly calculated the following measures for the proposed computerized tracking system project. So the IRR is given to us, ROC is given to us, and the payback is also given to us. So which of the following is true? So we will say that the project is definitely worthwhile because internal rate of return is lesser than your average return on capital employed. So the project is basically worthwhile because you will say that the IRR you're earning, which is 14%, is actually greater than your cost of capital, which is 10%. So that is what you will say over here, that the project is worthwhile because IRR is greater than the cost of your capital. Moving on. Okay. So Castilda company manufactures toy robots. The company operates a standard marginal costing system and values inventory at the standard cost. So which of the following is an extract of a partly completed spreadsheet for calculating the variances? So which formula will correctly calculate the direct labor efficiency variance in your cell B18? So let's have a look. We have to find out the labor efficiency variance, and cell B18 is this cell over here. So basically we know that our labor efficiency variance is nothing but standard rate multiplied by standard hours for production minus actual hours, right? So it is given over here that for this formula we'll have to choose that one where it is multiplying first of all the actual hours which have been taken, which is 26,000 hours. So 26,000, sorry, this is the number of units, and then how much it should be for 1 unit, it is 48. So this is standard hours for actual production multiplied by the standard rate. So 26,000 hours multiplied by 48. So this is cell C9 over here multiplied by cell C4. So this is okay, option 2 and 4 both have this as the first part. Then this should be subtracted with how much is your actual hours multiplied by the standard rate. So I can say that 150,000 is something which I have actually made, and then I will have to multiply this by 8, uh, which is your standard rate. So I will select this option over here. Now, Castilla Company uses a standard cost operating statement to reconcile budgeted contribution with actual contribution. Standard cost operating statement for month 1 is given below with some missing information. Okay, so the contribution is given to us. So we have to see which variance will come over here, and then we have the variances also given to us. So with respect to the cost variances, we are given material variance is adverse, labor rate is adverse, labor efficiency is favorable. Then the total variable production overhead variance is again 10,000 favorable. So now let's see what the gap 1 is supposed to be. So for gap 1, we have the following options given. So basically, the difference between your contribution and your standard contribution on your actual sales gives you your sales volume variance. So that is why this will be the sales volume variance. And again, we have to fill how much the sales volume variance will be. So let's work out that. So basically, sales volume variance is nothing but the difference of your budgeted and actual sales. So I can see that my budgeted sales were 25,000 and my actual sales came out to be 25,600. So this is going to be the difference, and this will be multiplied by my standard contribution, and my standard contribution is $28. So I will find out my answer as the difference between 25,000 minus 25,600, and then this will be multiplied by my standard contribution. Now again you will get your answer as 16,800. This will be a favorable variance. Why? Because your actual sales were more than the budgeted sales. So I will select favorable over here, and then I will enter my answer, which is 16800. Right. So with this, I move on to the next one. Now we have to find out the standard contribution on the actual sales. So the standard contribution is nothing but 28, and then this has to be multiplied by your actual sales, which is 25,600. So you will write over here, this will come out to be the product I just told. So this will be, again, you can also total both of these. This is 716,800. So this is your standard contribution on your actual sales. Then we have to find out the sales price variance. So sales price variance will be nothing but the standard, basically you will have to see over here that how much is your actual sales. You will multiply that by your selling price, and then you will subtract the actual revenue from this. So this will be your working. So this is 25,600 multiplied by how much is your selling price, which is 120, and then you subtract your actual revenue, which is 3066880. Now, if you solve this, you will find your answer as 5120, and this will be an adverse variance because you have earned lesser than what you have budgeted. Right. So with this, we finish all the blanks in task 2. Moving on to task 3 now. So task 3 says Castilda Company's management accountant thinks that the direct labor rate and efficiency variances for month 1 could be interrelated. So which two of the following could explain their interrelationship? So we have to select two statements over here. Actual production was less than budgeted. No, this will not link labor rate and efficiency variances. A productivity bonus was paid to direct labor. Definitely yes. So if they are paid more bonus, they will be working more efficiently. And then lower grade labor performed tasks less efficiently. No. Higher grade labor perform tasks more efficiency, because we can see that the labor efficiency variance is favorable over here. So they are working more efficiently. So that is why higher grade labor performed more efficiently. Moving on to the last question of our mock now. So again, we are having three tasks. Nicholson Company sells mobile telephones. It supplies its customers with telephones and wireless telephone connections. Customers pay an annual fee plus a monthly charge based on their calls that they are making. So company has recently employed a consultant to install a balanced scorecard system for performance measurement and to benchmark the results against those of Nicholson Company's competitors. Unfortunately, the consultant was called away before the work was finished. You have been asked to complete the work. Okay, so the following information is given. You have the revenue, you have attributable to new products, you have capital employed, PBIT, customers. Okay, so let's have a look at the tasks. First of all, we have to find out how much is our return on capital employed. So how do we find out the return on capital employed? It is nothing but your PBIT divided by the capital employed. So the PBIT that I can see over here is $48 million, and the average capital employed is also given as $192 million. So if you just multiply this 100, you will have your answer in percentages, and this will come out to be 25%. So I will enter 2525 over here. Percentage sign is already given. Now moving on to return on sales, we have to find out the operating profit margin. So let's work out that. So the formula that we'll be using again is PBIT divided by your sales revenue. So the PBIT that you have is 48, and then you divide that by your sales revenue, which is 480. So this will come out to be 10%. Again got erased. Okay, so this is 25. And this we had just found out as 10%. So I will enter 10 over here. Now we have to find out the asset turnover. So again, the formula that we have for asset turnover is nothing but your sales revenue divided by your capital employed. So the revenue we just had 480, and then the capital employed was 192. So with this, you will have your answer as 2.5. So if I just enter this over here, 2.5. Right. Now I move on to the average wait for a telephone repair to the nearest whole number. So we have to see that how much people are waiting for their telephones to be repaired. So we see that average telephones unrepaired at the end of each day is 804. And then how much in total are we getting? We are getting returns of 10,000. So again, this will be, we have to find out average. So basically, we'll have to find it out in days because that is what the requirement is. So this is 804 divided by total, which was 10,000, and multiply this by 365, as this is the number of days given to us in the question. If you work this out, you will get your answer as 29 days. So 29 will be the answer. Now moving on to task 2. Task 2 says, calculate the following statistics, give your answers to 2 decimal places. Percentage of customers lost per annum. So basically, how will we find that out? Number of customers that we are losing, and then dividing that by the total number of customers that we have. So basically, I can see in the scenario that my average number of customers is this, and customers lost is 117,600. So my answer will be 117,600 divided by 196,000, and I will multiply this by 100 to get it in percentage terms. So with this, I will have my answer as 6%. So it wants to 2 decimal places, so I will enter 6.00. Moving on to the percentage of sales attributable to new products. So we saw right above how much were our new sales. So the new sales are 8, and the sales that we are previously, the total sales are 480. So I can say that the proportion is nothing but 8 divided by 480, and this will be multiplied by 100. So this will give you your answer as 1.66. So I will enter this over here, 1.66. Moving on to the last task, and then we are done with this specimen exam. So complete the following explanation of a balanced scorecard. A balanced scorecard measures performance from 4 perspectives: customer, innovation and learning, financial, and blank. So let's read what our options are. Non-financial success, no. Flexibility, no. Internal business process, yes. The scorecard is balanced in that it requires the managers to deliver performance in all 4 areas, achieve on an equal number of KPIs in each perspective, no. Offset bad performance, no. So they have to deliver in all areas. And with this, we are done with this exam. Okay, so it does show me that there are some incomplete questions. Maybe I had entered my answers and it did not, it deleted those answers. So with this, we have come to an end to this exam. Thank you so much for watching this video. If you have come so far, I think you are able to get the hang of this. So if you have any doubts, feel free to leave a comment down below. You can also message us on our Instagram page, which is @BeingACCA. Thank you so much for watching. I hope it was useful. Catch you in the next one.